All right, so let's quickly go over the wheel strategy. I see a lot of YouTubers and other people trying to explain this. They make it way more complicated and they drag these videos out, but it's really not that complicated, and we'll just talk about it in a quick video here. Now say you like some shares, you wouldn't mind owning them. You can either buy them outright or you can sell cash secured puts against it. Now if you do a cash secured put, instead of buying the stock outright, you can obtain the stock at a discount. You collect a premium, so you're getting paid for stock you don't even own. And if the shares are not assigned, then you repeat the process. So with covered calls, you can sell calls against the shares that were just assigned to you from the cash secured put. You collect a premium. If the shares are not called away, then you repeat the process and keep collecting premium. If the shares are called away, then you can turn around and do more cash secured puts. Let's take a look at a real world example here. So if I wanted to look at, for example, TQQQ, this is an ETF that follows the QQQ, the NASDAQ 100, and it provides 3 times leverage. So it can be good. If QQQ goes up by $1, it'll go up by 3, but it could also be bad because it works the other way too. So you got to be careful. But as an example, let's take a look at here. This is trading at 83.24, and if I wanted to get into this, first I do a little research. I could look this up, TQQQ, and I usually pull up the Bollinger Bands. It's actually kind of high right now. The RSI, between 30 is oversold, and above 70 is overbought. So it's pretty much overbought. I wouldn't go into this trade right now because you want it to be on a down day down here on this end of the Bollinger Band, because you can see if it hits the bottom here, it goes up. If it hits the top, it's likely to go down, but it's still too high right now for me. And so the probability is that it might go higher. So you don't want to do a put now, but we'll do an example. If you start with a lower price, it's more likely it's going to go up. And as a put seller, you want the price to remain above the strike price. Okay, so it's trading at 83 and some change. Go trade options. I like to go weekly, so now it's Sunday, so we'll go 5 days out to this coming Friday. Sell, put, and if I go down to, let's choose this price here. Let's say I want to pick this as a strike price. So this would mean there's a 75% chance of profit for me. That roughly corresponds to this delta number. If you don't know delta, I have some lessons on that too. But that's pretty important for choosing a strike price. I usually want mine to be under 30, under 25 usually. But for this example, we'll make it easy because this is an 80 strike price. And we would collect $1.09 here. You can see what you'd get for doing this trade and selling this option. So $1.09 per contract, and a contract is 100 shares, so that would be times 100, $109. Over here you can see as a cash secured put, you do need money to put aside in case you do get assigned the shares. So with this trade, it's trading now at 83.24. If at expiration on January 24th, 5 days from now, if the stock price drops to 79, let's say, then it'll be what's called in the money, and it'll be more attractive for the option buyer to want to exercise that option and force me to buy those shares. So that's what you do. You set this aside, but there's a 75% chance that won't happen. So it's a good bet for me. I can make $109 by putting up, it's actually 80 here times 100. So it's 8,000 minus what I would make here on this trade of $109. So 7891 is the max loss. And I hit continue. I could do more contracts. I could do 5 of these. Then I would collect $544 in a week, and I'd have to put up around $39,455 to do that. So that's what you would do to start the wheel. And technically today you're getting them at a discount because the price is 83, and the price that you would want to exercise this option at is 80. So for that to happen, it would actually have to go at the end of expiration below 80. So it's not really a discount at that time, but it's a discount from when you started, which is 83 right now, and it's more likely to go up. So you want to choose the strike price down here that's got a good premium, but it's not so likely that you're going to get put the shares, unless you want to own the stock. If you want to own this, then it's fine. You can be more risky with your deltas. If you go up to closer to the strike price, it's more likely that that's going to happen. So the delta is higher. There's a 40% chance of this going in the money, or 68% chance of profit here. You collect more because the option is worth more, but you're more likely to have to be forced to buy the share. So that's the kind of the balance you want to take into consideration. So let's say I did this trade. I collected $109 just for one contract, and if at expiration the price is above, then I would keep the premium. My collateral would be released, so I can use it again, and I could just do this trade again or do some other trade. So I like to track these in the sheet. So I put in here the date of 119, the stock, the expiration, so the days to expiration, DTE, how many shares. This is one contract, so it's 100 shares. The strike price we were talking about, and the current price, the delta, the type of trade it is. It's a put, and this is in process. You can change your status depending on what happens at expiration. The premium collected, I won't get into it here, but sometimes you might have to buy this back. So the result is the actual, what this total monthly income happens to be. So if the price stays above this strike price of 80, then it'll be out of the money and the option won't be exercised. And I would keep this premium of 109. And then what I would do is I would probably just do it again. So the next week I would probably just put it in there. And so this would add up to a total of 218 here, depending on what the result is next week. But let's say the price went below and I was assigned these, like I said, maybe went to 75 or something. And so I would go that this was assigned, and then I would go back here. So now I've been assigned, I have 100 shares and that I paid for with the $8,000. I would go to the stock and I would trade, and then I would go sell the call. And another 5 days out. So let's say I got these at 80, so the price might be fluctuating around here. But just as an example to share, what you always want to do is if you've got the shares, you never want to sell them for less than you picked them up for. So I bought these for $80 a share, and I would have to sell calls at that. So I would go to, let's go to like 84. I could select this and make the difference between, if these are called away, I could make the difference between 80 and 84. So that's $400. And I would collect this premium of 181. Delta is 45.82. So I just put this in my sheet. The 181 is the premium collected, 84 is the strike price, and the delta is 45. I put all that in here. Like, let's say pretend this is next week, and we put this other premium in here. We can see this adds up to this, and you just keep going. I like to do weeklies. You can do monthlies if you don't want to manage these as much, or you can, some of these, the top ETFs, you can even do dailies like SPY or IWM or QQQ. So that's just how that would go. And if the price now for this call stays below 84, I would just keep the premium, and I could do this again the next week. If the price goes above, the option will be exercised, and I would have the shares called away from me at 84. So I would make the difference between what I purchased them for of 80 and 84. I'd get that appreciation plus all the premium along the way. So this is, best case scenario. There are some risks in the wheel strategy that you need to be aware of, but that's the basics of how it works. And if you want to know more, just follow along and ask me any questions. Leave your questions in the comments, and I'll get back to you. Thanks for watching. Bye.